Are Phoenix home prices overvalued and is the housing market going to crash? I'm going to tell you why everybody thinks the answer to both of those questions is yes, but why it's actually no. I'm Dylan Bucknavich of the Buck team. I'm a realtor, I'm a former home inspector, I'm a husband, a daddy, and a below average hockey player. So it's Phoenix, it's December, it's perfect out, and it's beard season. What more can you ask for? But it's been an interesting year. In fact, I would say that this year has seen more change to the market than any year since probably 2010, 2011. And there's more change coming, but I get it. So, in my line of work, even with friends, whether they care or not, they always ask, how's the market? And my answer is always the same. I say, it depends. Are you a buyer? Are you a seller? What's your price point? And where are you located? You tell me those three things, I'll tell you how your market is. But during that conversation, I've been seeing a lot lately. Everybody, not everybody, but a lot of people go to a point and they say, well, I see a crash coming. This bubble's going to burst. And I get where that comes from. I understand. Appreciation rates have been pretty crazy lately. I think 5-10% on average, which is nuts. There was even a report earlier this year by a company called Core Factor, this big fancy research company, calling us one of the most overvalued markets in the country. I think us and about 30 other cities got put on that list. But we all know what happened. After the crash in about 2010, 2011, the market hit the bottom. Prices were really low, supply was great, so buyers just had their pick of the litter. They could go in, they could buy up, and people have been buying homes like crazy. Then you throw in the big buyers, companies like Open Door, OfferPad. There's a bigger one, Cerebus or Cerberus, something like that. They started buying a ton of them. So since then, all these demand was crazy. Over time, the supply really started to take a hit, and it started to plummet to record lows. You have all this demand, dwindling supply, hence appreciation going up. Um, but earlier this year, sometime between May and August, I started to see a trend. A lot of buyers I had been working with started pulling out of their search, saying, you know what, the competition's too fierce. We're losing out. We just wrote 5 offers. We didn't get any of them. And they started quitting. And I get it. The competition was real. Sellers had it really good for a while. They could just call their shots, and they were getting offers above asking price. They wouldn't give in to closing costs, anything like that. However, because of that demand, and I called it buyer fatigue, and it was real. And I didn't know if anybody else saw it, but I just saw something coming. And sure enough, since then, supply has been slowly climbing. And in fact, November last month was the first month in over a couple of years that inventory was higher than it had been 12 months before. And it was also the fourth month in a row that inventory has gone up. And December looks like it's going to do the same thing. So with that, now we're seeing a slowdown in demand and an increase in supply. So what we're seeing as a result is a decrease in listing success ratio, which is naturally the number of homes on the market that are getting a contract. So now sellers are starting to react, saying, oh, we don't have it on Easy Street anymore. It's still seller's advantage, don't get me wrong there, but they're starting to react. And we're seeing two things. We're seeing price reductions, or we're seeing sellers give some of the buyer their closing costs back, whether it's 1, 2, 3%, whatever they ask for. Um, Here's where it gets a little bit tricky. Now, even though we're seeing price reductions on these list price, it's not going to affect home values because those list price are still based on that current appreciation of 5 to 10%. So even with these price drops, once these homes close and sell, all we're going to see is a reduced rate of appreciation, not a crash. So to sum up, what I think is going on, and what I'm pretty sure is going on, is we're seeing a shift. This is not a crash. We're seeing a decreased rate of appreciation, and I think it's going to average out at about 2 to 5% from now on out. From now on, and what that means, it's something we haven't seen in a while, which is just a nice, boring market. That's it. And if I'm wrong, I don't think I am, but you can call me up and yell at me, whatever you want to do. Let me have it. Comment below. Let me know what you think. But I that's where things are. It's just going to get nice and boring. It's still going to be a seller's advantage. We would need inventory to climb up, I think, another 1 or 2 months of supply. And we had gone from 1 month supply to about a 3 month supply of homes. So if that gets up to that 4 to 5 month, which I don't know if it will, then it's going to be completely balanced and sellers will start to lose the advantage. But I don't see that happening for a while. We still have a lot of jobs coming up, a lot of new builds. So there's plenty of opportunity for sellers to take advantage. But things are definitely evening out. And that's about it. So I hope that makes you feel better about where things are. Feel free to let me have it or agree or disagree below. And I'd love to have a little conversation about that. All right, we'll talk soon.